Hi, Max Keiser. Welcome to On the Edge. Let's not waste any time. Let's go right to Niceville and speak with Karl Donninger of MarketTicker.org. Karl is coming out with a new book. It's now available for pre-order. The title is Leverage, How Cheap Money Will Destroy the World. Karl Donninger, welcome back to On the Edge.
Hi, Max. Thanks for having me back.
Okay, Karl, the Swiss National Bank has just pegged the franc to the euro in order to lower the value of the Swiss franc. What's going on?
Don't you just love 8% currency moves in the space of about 2 minutes? That, by the way, blew out all-time records for currency volatility, at least as far back as I've been able to determine. The problem that the Swiss have is that the CHF, the Swiss franc, has turned into a safe haven currency. It's much like gold, except that unlike gold, there's actually a lot of liquidity there because it's not a thin market. The foreign exchange market, of course, is extremely deep and liquid, whereas the metals market is extremely thin and illiquid. And so people have been piling into the CHF, and this creates a big problem for Swiss exporters because as the currency gets stronger, you have this problem with exporting. The value of your currency goes up, and therefore your goods and services become more expensive to export. So this is the Swiss National Bank's attempt to stop that. The problem with doing it is that the only way you can actually make that happen in a floating currency world is to print however much money is necessary in order to weaken your currency to the desired level. And that's what the Swiss National Bank has basically said they're going to do. If you remember, they made an attempt at this a year and a half or so ago, and I think they gave up after they went into the hole something on the order of tens of billions of dollars. So it'll be interesting to see how long they continue to do this and what the reaction is of the Swiss people when they see their purchasing power decimated by this action of their central bank.
How does the constituencies break down here? He's helping his some group within the economy, but he's sacrificing others. And of course, second of all, here this isn't free market capitalism, is it? This is planned control, control and command, centralized capitalism. So who is he really working for here?
This kind of a policy is like any other policy of a government, Max. Government can only take money from one person and give it to someone else. That's all it's capable of doing. That's all government has ever been capable of doing. That's all central banking is ever capable of doing. When what the Swiss National Bank is doing is saying we're going to favor exporters to the detriment of consumers and importers, because let's face it, Switzerland does not have the ability to produce everything it needs, including food and energy, within its own borders. So essentially what the Swiss National Bank has said is that we're going to punish those people who live here and those people who actually need to consume and import things in order to protect a tiny little segment of our economy that provides exports. You have to wonder the wisdom of this. I have long said that the euro is heading to par with the dollar. And as you see the disintegration of the euro, people over in Europe are looking for convenient places to put their money. And the Swiss franc has been a convenient place because, let's face it, they're right there.
Right. Now, of course, if you're a saver in Switzerland, you just had your clock cleaned, right?
Yeah, that's a polite way of putting it. I think it was a little more violent than that.
Right, and the low interest rates, or the attempt to keep interest rates low, it's something we see around the world, isn't it, Karl, where it's seeming that the government and the central banks are helping the speculators and the leverage players and the borrowers at the expense of their local population. They seem to be in bed with the speculators, and the speculators don't really add anything to the economy. Do they?
There's a big problem here, Max, in that the only way that you get long-term economic prosperity in any economy is through capital formation. Capital formation is just a fancy word for savings. And unfortunately, what has happened here, and Bernanke has made this very clear, he's not alone, but the goal of these central bankers since this crisis began, which they created, by the way, and that was through their own policies, has been to say, well, we have to protect asset prices. And in order to do that, we have to force people who would otherwise save and form capital into the capital markets. This has been Bernanke's explicit goal. He has taken credit for the fact that the Russell 2000 went up by over 100% from its lows in 2009. And yet I'm sure he just loves the price action over the last month or thereabouts, where it's, gone back down, of course. But at the end of the day, this is a transfer mechanism, because Granny, who saved up a few $100,000 and had it in CDs and was living nicely off a 5% interest coupon, now has zero interest. She can't make any money except by going into the stock market. And she goes back into the stock market in 2009, 2010, and then immediately loses 20% of her money.
Right. Now, the word transfer is an interesting word, and I want to, the title of your book, Leverage, How Cheap Money Will Destroy the World. When you have, let's say, Granny, as you say, she's got money in her CD, and that's parked at the bank. The bank, of course, uses, through fractional reserve banking, that capital to leverage and to play in a leverage game around the world in the way that we've seen. But they can play an even greater leverage game if they coerce or entice Granny or savers to exit that CD market and to put it directly into the mix of the equity markets, where they essentially, the goal here is to allow the leverage factor to increase, right? Because they want more debt to equity, they want more leverage, they want more volatility, isn't it? So they're enticing this capital into this casino because it's more profitable if you run the casino, right?
Max, that's true, but here's the problem with doing that. Speculation is inherently nothing more than finding a greater fool to sell your asset to at a higher price. It's a Ponzi scheme, because the only way I can make money by speculating is if I can find somebody to give me more for what I just paid for. This ultimately, eventually run out suckers is essentially what ends up happening. The only way that you get forward economic progress is to increase output. And the only way that you can increase production, that is output, is to form capital. So when you do this to Granny and you say you have to go out into the markets, otherwise you're going to lose money to inflation, you're going to lose money to your purchasing power, what you've essentially said is, we're not going to have any more productive investment. And that's what you're seeing here in the United States. There's been no job growth in terms of the percentage of the population, the percentage of the working population that has a job over the last 2.5 years. And this is the reason. It will not change until capital formation stops being punished.
You mentioned output has to be improved. The GDP is another word for output. The GDP, for that to grow, there you have the capital formation necessary for a sustainable economy. Now, the argument from the Swiss National Bank and from Bernanke and from other central banks is that by lowering their currency value, by attacking their own currency, they're going to increase their exports, and this will create jobs, and that's the basis for creating capital. However, what we've seen is not that, is it? Because before the money gets to the job-creating elements of the economy, it's co-opted and annexed by the banks, who just use it to speculate, correct?
Yeah, it's a little more complicated than that. Of course, everyone cannot have a weak currency. Someone has to have a strong currency. So essentially all you've done is taken the capital and had it flow somewhere else. If the dollar is cheap and it makes exports more attractive, that sounds like a great idea, except that we need to import energy into this country in copious quantities because we have no energy policy. And in addition to that, we've offshored all of our manufacturing. Henry Ford figured this out an awfully long time ago. He was paying his people on the assembly line far more to put cars together than an unskilled laborer would make. In fact, he was paying them essentially the same amount of money that the people at the Packard plant who were not assembly line workers were making. And when he was asked, why are you doing this? You have essentially people who have the skill set of someone who sweeps floors assembling cars, and you're paying them most money. He says, you know what? If these people don't have decent incomes, who's going to buy the cars?
Right. Well, that lesson seems remarkably obvious to any businessman with any kind of acumen whatsoever, and yet it seems to completely escape any of the folks in the U.S. Is it simply because it's so easy for them to outsource to foreign countries and they have no need for the American consumer anymore? They've turned their back on the American consumer and the American citizen.
If I can employ slave labor and pollute the water and air, and by doing so cut my cost of production by 20%, if I'm a greedy capitalist, that is the obvious thing for me to do. If, on the other hand, you are a government and you care about these kinds of things, then you should stop that. And that sort of thing is exactly why tariffs exist in the world. It is to prevent the exploitation of offshore resources of various sorts that are then used to destroy your own economy. It sounds great to have all of this cheap labor, but what it does is suck the capital out of your country into those other nations. So we have seen this huge flow of capital and resources, human resources, out of the United States, into Mexico, into China. And what do we get for it? We have, sure, our DVD player costs $30, but nobody makes DVD players, nobody makes high-tech electronics in the United States anymore.
Right. So let's walk through an example of an average American consumer. They've lost their job, or their wages have been curtailed, or their wages are stagnant for 20 years. They go to Walmart, however, and prices are down. So they are happy because they are experiencing lower prices thanks to the slave labor of the manufacturing going on overseas. But isn't it true, Karl Donninger, that for every, let's say, 1 or 2% that an American worker saves at discount at Walmart, they're losing more in percentage terms in wages? So isn't that kind of a poison chalice?
It's always a poison chalice, because not only are you losing there, you're losing the currency debasement. The only way that you can continue to keep this cycle is by keeping the dollar cheap. You lose in energy prices. Look at what's happened to the price of a barrel of oil over the last 10 years. And on top of that, then you get the financiers involved in this, and look at what occurred with the price of housing and other necessities. Then add on top of that the government leviathan with all of the welfare programs to pay for all these unemployed people that lost their job in the United States. And all of a sudden you have a government budget that is more than doubled, and yet the ability to collect taxes, which is predicated upon the employment rate of the population, has gone through the floor. It's back to where it was in the 1970s. So we have a government that is spending like a drunken sailor to try to keep people off the streets, and at the same time they have no ability to fund that expenditure with current tax revenues. It's a death spiral, and it has to stop.
Is it an inflationary death spiral or a deflationary death spiral, or a little of both?
Depends on where you stand in the cycle. There are many people who believe that we will have some kind of hyperinflation event in the United States. The problem with such an event, if it occurs, is that the bottom 4 quintiles, that is the bottom 80% of American society, ends up literally destitute and unable to feed themselves under that scenario. So that is the path down which you have civil unrest, maybe civil war, and maybe something much worse than a civil war. You might have a global conflict that comes out of that. The other option, if you were to, for example, take that leverage out of the system, force those people that made bad loans and those people who took bad loans to default and go through bankruptcy, you take about half of the total credit outstanding in the system in the United States. It's roughly $53 trillion in total. So 50% of that would be about $25 trillion. You take about $25 trillion worth of debt out of the system, that would rebalance it. Now, that would bankrupt many of the large financial institutions, and it would bankrupt a lot of Americans. But after you go through bankruptcy, you have a clean balance sheet. What's the harm here? We need banks. We don't need the specific banks that we have today. I need to be able to clear a check that I write to you, but I don't care whether or not it goes through Bank of America or J.P. Morgan.
Okay, so that's a good point there. You say we need banks, but we don't need the specific banks we have in place, because what we hear all the time during every phase of this crisis, the big banks, the too big to fail banks, go down to Congress and they testify that basically if you force us to pay the debts that we incurred, we're going to crash the system. And what you're saying is that we should call their bluff and let those guys crash and start again would be better than the other route, which is printing money ad infinitum, hyperinflation, and 80% of the population destitute.
You're not going to get away with the second path. It can't work, Max. When you look at the reality, in order to balance the system by printing money, you'd have to print $25 trillion. All right, even after the expansion of the Federal Reserve's balance sheet, he's only got $3 trillion or so on his balance sheet. He's put about $2 trillion on and had about $800 billion on when we started this mess. So you're talking about devaluing the dollar by a factor of 8. All right. So in order to do this through that path, the dollar would be worth, today's dollar would be worth 15 cents. Well, that would mean that the price of gasoline, instead of being $2, would be $16 a gallon. But who can afford to go to work?
Walk us through a little bit about how you get to this $25 trillion number. I think people understand now that it's there are many trillions of dollars that we're talking about here. How do you frame that? How do you get to that number? Just roughly speaking, nothing too specific.
If you take a look at the Federal Reserve Z1, which breaks down all the different categories of debt and where it all resides, essentially the explosion that fueled this boom started in 1980. And it came, for most purposes, in the financial products. That is, bank loans and guarantees and swaps and all kinds of other hinky games. All right. The current amount of credit outstanding to homeowners in the form of home mortgages is about $10 trillion. So, and that, just to put some perspective on this, the financial products universe is about twice, 2 to 2.5 times the size of all of the mortgages that are held by consumers in the United States. That's an outrageous amount. And the reason that I look at this as about 25 trillion is that on a sustainable basis, when you look at nations over the long term, they can manage to hold a total debt to output in the economy ratio of somewhere in the neighborhood of 175 to 200% of their output. We're at approximately 375%. We're roughly double that number. So if we were to go back to our sustainable level, which is where we were before the 1980s, we would be at approximately 24, 25 trillion, and today we're 53. So it's just subtraction. Now the question becomes, why are we there? And the answer is because we've made promises that we cannot pay, and we've allowed institutions to lie about the value of things that they're holding. The entire reason that the banking sector is coming apart over in Europe is because you have banks that say, we have all of this debt, and that's an asset to a bank, and it is money good. It's 100 cents on the dollar. But the market says that Greek bonds are trading at an implied interest rate of 50%. Well, both of those things cannot be true. Either the bond is only worth 40 cents on the dollar, or the bond is really worth 100 cents on the dollar, and the interest rate should be 4 or 5%. Well, which is it? And the market is saying, you, Deutsche Bank, you Credit Suisse, you Santander, all of these other institutions, you're lying, okay? And the same thing is happening over here in the United States. Bank of America right now is selling on the open market their stock at about a third of its alleged book value. If anybody believed that that was real, that the value of those assets was true value and not a lie, they would buy the bank tomorrow. They'd just go out and buy all the stock because you'd immediately make a 200% capital gain. Why would anyone in their right mind not do that if there was anyone with money that believed that these were real values?
Okay, I want to revisit this debt layer cake just a little bit more so people can get a sense of the dimensions and of debt we're talking about. The U.S. country of the United States has about 14 trillion or so in debt. That's about almost just under 100% of GDP. On top of that, you're talking about private debt, right? Debts on the balance sheets of banks, mortgage debt, and other debt facilities, which bring that indebtedness up to this 25 trillion level, or I believe you said, 370% of GDP, correct?
Actually, Max, the only debt that's counted by the Fed on the Z1 in the federal is about 9 trillion. They don't count the Social Security and Medicare transfers, which is bogus, but so you have to add about 4 to 4.5 trillion more to it. The total is 53 approximately as of the last quarterly report. But yeah, that's all debt, public and private. And when you look at the growth in both output and debt from 1980 forward, up until the crash, there was not one single 3-month period where we increased output in the economy faster than the debt increase.
Right. So this is a classic case of trying to perform a debt transfusion to a corpse. They're not responding. Now, Karl,
we're playing Wimpy, Max. Wimpy, we've all seen the Popeye cartoon, right? Wimpy goes in and says, "I'll pay you next Tuesday for a hamburger today." Well, we eat the hamburger, and then next Tuesday comes and we're hungry again.
It's the wimpy economy. All right, we've got about 2 minutes left, and I want to kind of go off the range here a little bit, because you mentioned at the top of the show that the Swiss franc had an 8% intraday move, the biggest intraday move in the history of Forex trading. Do some out-of-the-box thinking here. Where are we going to go in the next 6 months? If the volatility is 8% and it's only growing, what are some of the scenarios that we might see here?
I am very curious as to exactly how this will play out over the next weeks and months. I suspect that the Swiss National Bank passed through the back channels to most of the major national and international banking infrastructure that they were going to do this before they did it, because otherwise you would have instantaneous detonations in the trading desks and and within the banking infrastructure across the world. That's an unprecedented kind of move, and it's insanely violent. There have been hints dropped that something like that was going to happen. I don't think that you're going to see any decrease in the volatility nor any reason return to these markets until we have some adults in the room and the truth is told about who is holding what liabilities where and what those assets that are supposedly backing these liabilities are actually worth. And so far, all we've had is lies, lies, and more lies.
Right. When you say which banks are holding what assets, I think one of the ugly truths here is that the same assets are being held by multiple institutions. And then they take turns either reporting or not reporting these debts, depending on who's up to report their Edgar SEC requirements that week. So it becomes a bit of a hide the parcel scam. On top of the overall indebtedness, there's also an underlying what I call peekaboo accounting fraud. Do you see evidence of that?
Yes and no. I think most of that is being done through the over-the-counter derivatives market, and the big issue there, of course, is that if you have a position that is extremely dangerous, whether it's a subprime mortgage bond or whatever have you, if you have supposed credit protection, you can claim that it is 100 cents on a dollar, it's money good, because if something goes wrong, you're going to get paid. The problem is there's no one to prove that your counterparty and all of the chain behind him, because these people chain risk, are actually able to pay. And that's where we got in trouble in 2008, and that problem has not gone away. Our regulators have refused to address it because that is the essence of how you can have a balance sheet that looks perfectly okay one day, and the next day the entire institution is a smoking hole.
Yeah, hello, Enron. Okay, Karl Donninger, that's all the time we have for this week. Thanks so much for being on the edge.
Anytime. Thank you.
All right, that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, Karl Donninger. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.